Hi, my name's Anna Serin. I'm Director of Listings Development with the Canadian Securities Exchange, and you are joining us for our first week of the live weekly market update. Thank you for joining me, Bruce.
Yeah, it's exciting to be doing it live here this time.
So I'll just clarify a few things about this live forum. You're welcome to join us every week live. We're going to set up the opportunity where people can make some comments as we chat. So stay tuned for that. Join us when you can, but it will be posted in the regular channels after our chat, so you can still catch up with it anytime that you like. So let's jump right into it. There was a bunch of stuff that happened this week. We had your colleague with us last week. He did an amazing job. Thank you to Jordan for his help. We're going to talk about what happened this week on the Nasdaq and Russell sell-off. There was some major movement there. There was a bunch of movement into mutual funds this week, what that meant. We'll talk about a big merger, Canada and US. It was CP Rail and the Kansas City Southern. It's a $25 billion merger and some pretty neat stuff that'll come from that. There was an interesting merger this week with WeWork. I think we've all watched it for the past few years. It's had an interesting past, and it has merged with a SPAC. We'll talk about what a SPAC is. I'm sure you've seen that name a lot these days. And we'll end off talking about a direct listing that occurred in early March with Roblox. I'm sure if any of you have children out there, you know that name. So we'll end off with that. So Bruce, talk to us about what happened with Nasdaq and Russell 2000 this week.
Yeah, I mean, basically since the peak of the market on the 15th of March, we've seen very significant sell-off in the Russell 2000 and the Nasdaq, and these are really, kind of the way we equate it is everything that worked last year and really even for January, February, basically stopped working for this period of time, and so you saw a fairly significant sell-off in both of those markets. The interesting thing that we noticed was that two things. One was that the volume wasn't as high as you would expect. Typically, when you see a sell-off, it's on high volume, and that's really sort of giving you a sense of that panic. And then the second thing is that the VIX, which is the volatility index, normally you'd expect to see it spiking when you saw a sell-off, and we didn't see that this time. So it's kind of an interesting cross current that's going on in the market. A lot of the sort of more traditional areas of the market have hung in actually pretty well, and if you look at the TSX and even the S&P, they're not very far off their all-time highs of last week.
Well, the Russell 2000, let's talk about that, because I don't know if as many people are aware of this index. The Russell 2000 is a small cap index. It's made up of 2,000 companies that are mainly US companies. Traditionally, it's been viewed as a bit of an indicator for the US economy because it's smaller companies that are involved. Is this a good thing or is this a bad thing? What does this mean?
Well, you actually saw a fairly big move in, the Russell really post kind of November, but even prior to that, after the market sold off last March, from March to November, it had a fairly big move, and that was just the fact that most people felt that smaller companies could adapt and move quicker than the larger companies could. So, in the start of a bull market, typically you see those companies recover and do quite well, and then sort of later on in the bull market cycle, they tend to have a little bit tougher time when you see some of the headwinds coming their way. We haven't really seen that yet, but what we really think's happened is that there was this sort of big talk of retail participation in the market, and how a lot of these new investors or these retail investors were new to the markets. And so, they were looking for kind of that new, hot, sexy trend names, which would encompass a lot of the Russell and the Nasdaq. And now it seems like, they've sort of had their first taste of a sell-off here, and they've really sold down and been hurt. And it seems like, kind of the money managers that are there for, sort of the stability of the market and look for valuation to be cheaper are really kind of taken over, and they're moving into other names that necessarily some of the newer investors haven't discovered yet.
Well, and I think one thing just to explain, because obviously this is a big part of what you do, but as a fund manager, you build out a mandate that has certain, an asset allocation within the fund. And if the small cap stock has done so well, you have to rebalance that so that the weighing in the fund, is all balanced. So sometimes we see that sell off as well, just because there's a bunch of funds that need to rebalance. Is that right?
Yeah, funds and bigger institutions as well. You know, if you're coming in, especially coming into the end of the quarter, if you're an institution that looks at it from an asset allocation standpoint, you have a certain percentage of your portfolio that's been set up into, you know, the small cap or into technology. It's really outperformed. So you're taking some money from that area and putting it into areas that haven't performed. That's just the rebalancing that happens on a normal basis.
Absolutely. Let's talk about, speaking of which, let's talk about mutual funds. There was some activity in mutual funds over the past month. Tell us about that.
Yeah, so you know, there's the data on mutual funds in the U.S. is pretty robust for sure. And what we saw was one of the largest. Well, it's actually the largest that we've seen in 26 years so far in the month of March. The inflows that have happened. There's been about $75 billion that have come into mutual funds, whereas normally, I shouldn't say normally, it obviously varies a lot, but you know, we would sort of been expecting kind of in the last few months around that sort of 45, 50 range. So it's showing you that, you know, investors are really coming on board into the market. We sort of look at this from a contrarian standpoint and from a sentiment standpoint is that, you know, kind of all that money's coming in at, you know, as the market's already had this huge move. If this was, you know, March of last year when the market was bottoming, then you can kind of make sense, like, you know, buy low, sell high, right? Instead, we know that traditionally, you know, mutual fund investors and retail investors tend to be kind of late in their approach. And so, you know, it's not too surprising that we saw this big inflow kind of in the first part of the month. And, you know, now all of a sudden the market's topped and, you know, got a little bit choppy here. So from a sentiment standpoint, we're not kind of too surprised to see what the market's done here.
Crazy. That's a huge jump. Let's talk about a big merger that happened. I think this is a really exciting merger. So this is CP Rail and Kansas City Southern. This is a $25 billion merger where CP Rail has offered to purchase Kansas City. So shareholders in Kansas City will receive CP Rail shares if the transaction closes. I will note that is based on getting approval. So there's some approval from, what is the name here? Surface Transportation Board needs to approve it. They don't expect that approval to come through until 2022. So we'll have to wait and watch this one play out, but it'll be the first rail that'll go from Canada to the US to Mexico, which is kind of shocking we don't have that organized already, but it's a big merger. What does this mean?
Yeah, I mean, obviously from an efficiency standpoint, there's so much global trade. You know, those railways are all connected now. It's just a function of, you know, the freight has to be handed over from one company to the next. So, you know, now if you had auto parts or you had commodity that was moving north or south, it can basically go all the way with one carrier. So, you know, I've sort of heard some of the talk from the CEO of CP, and you know, he's talked about the efficiencies and talked about, you know, what this means for some of their customers. And it's, you know, it sounds like there's going to be some fairly interesting advantages here. You know, one of the things that, as to your point, it's interesting with a merger of this size and this scope, you know, they don't think it's going to be really finalized until late 2022. There's quite a process that's involved. You know, you know, at some point in time, Kansas City will actually go into a trust that will be still separately managed, but part of CP. And then eventually, if they get all the approvals, then at that point in time, CP will take over and amalgamate everything, which they think is going to be, you know, sort of late 2022. So, you know, in an industry that has a big regulator and has competition bureau, it's one of those things that's going to take a while to kind of sort out.
Do you think that once we kind of can all leave our houses and the pandemic has cleared up a bit, do you think that this will create a resurgence of traveling by rail?
You know, I'd be surprised. I'd be surprised if that's the case. You know, maybe in certain areas for sure. You know, I was thinking more, you know, on that perspective, if we still can't travel internationally, then, you know, maybe there's going to be more domestic travel, and, you know, something like the Rocky Mountaineer, which runs through the, you know, Rockies out of the West Coast here. Maybe something like that has a resurgence. You know, Kansas City and CP, they're not really hauling a lot of passengers. It's mostly freight. So I don't really think that's going to affect their business, you know, too significantly.
Well, I mean, I've heard that the Rocky Mount one is unbelievable. So it'll be interesting to see that play out. We'll be watching it for a little while. You know, one interesting thing about the rails, and people might not be aware of this. I mean, the railroads, they have traditionally been a huge impact on the stock market. I mean, when railroads were being built originally in North America, and I know in other countries in Europe, you know, one of the first shareholders were they were building the rail across landowners and giving them shares in the rail to be able to use that part of the property. So the railroads have a huge history in the stock market. So it's interesting to see it come back to light again. Let's talk about WeWork. So WeWork has, I think we've been watching it for a few years. It's had an interesting path, and it's just finally completed a merger with a SPAC. So let's talk about WeWork first, and then we'll talk about what a SPAC is.
Yeah. So obviously, WeWork is the work centers that have really populated the continent and actually the world. And prior to COVID, they were there was huge growth and huge area of increase. WeWork tried to go public. They've had obviously challenges raising money. They've done private rounds, they've done up rounds, they've done down rounds. The last time they were, kind of doing their IPO, it kind of got postponed and shelved based on, a number of different things that were happening. And so, now in the SPAC environment, I guess it's not too surprising that, someone from a SPAC has decided to combine forces with WeWork.
Well, and just to touch on their attempt to go public. So that was in 2019 that they attempted to go public. The valuation was about $47 billion. This transaction occurred at a price tag of $9 billion plus liabilities. So I guess that's a bit of a down round itself in valuation. Obviously, for office space where it was easily movable, you could go. You had a membership. You could take a desk. They worked really well, kind of as incubators, and without having those long leases. But with the pandemic, you got to imagine that might be a bit of a tough business model for them now. So it's interesting that they're still working at coming to market. I think people have heard the name SPAC a lot over the past few months. So I just wanted to touch on it and explain what it is. So SPAC stands for Special Purpose Acquisition Corporation. In Canada, the only thing, we have SPACs in Canada, but we also have another product on another exchange called CPC, which is like a small SPAC. Can you tell us a little bit about SPACs?
Well, they've been around for quite a number of years, and just in the last probably 12, 18 months, they've really gained popularity. There's been more issuance of SPACs or more formation of SPACs than we've ever seen in history. I think there's around 300 now, just since this year started alone, if my number is correct. And effectively what they're doing is you're investing into a company. It's almost like a blank check. They raise money and their promise is that they're going to go out and try to find a business. If they find a business and all the shareholders vote in favor, then that business gets put into that publicly traded vehicle and away they go. If the shareholders decide that they don't like that transaction, they can vote against it and they get their original investment back plus some interest. So typically these SPACs are $10 issues, and it means you get sort of, 10, 15, 10, 20 back if they don't go through. And if they do go through, obviously there's been some, hugely successful ones that have gone, sort of from $10 to $80, $90, $100, which is a fantastic return. It's getting more difficult, more challenging now to find businesses that we can roll into these that haven't already been de-SPACed. So, it's interesting that there was an ETF launched back in October, and it's basically an ETF of SPACs, and it was high flying, did phenomenally well. And just in the last couple of weeks here, it's actually sold back down to its issue price back in October.
Yeah, and I think one of the reasons we're seeing so much of it's a conversation I started having in the US with lots of people a few years ago. And it really is a symptom of the fact that there's just so much capital coming to market. So, we have supply and demand within the market itself. Sometimes there's lots of deal flow and sometimes there's just lots of capital. And so this is a vehicle that's used to kind of deal with all that capital coming to market. So it'll be interesting to see if we're going to see more of those come to market. I wish WeWork all the best. I'm glad that they found a spot. Now let's talk about Roblox. Roblox has been in my household. In fact, my children are upstairs right now, probably on Roblox. Let's talk about Roblox. So Roblox is basically an online platform that allowed people to go in on this platform, create their own games, and it allowed users to come in for free and use those games. So here's a few stats on it. There is a few million games on the platform itself as it stands today. And there are 33 million daily users. 70% of those users are under the age of 13. And their average usage time in a day is 100 minutes, so about an hour and a half. Those are just staggering numbers to me. And so it did direct listing in March. I think it went to market on March 11th. So talk to us a little bit about the direct listing.
Yeah, so direct listing is a way for companies to go public that already have an existing shareholder base and also have capital. And so what it allows them to do is they can, file a lot of the same documents that you would, or similar documents that you would have if you were going public, and effectively you just directly list without raising money at that point in time. You see it both in Canada and the US. It's just another route to get public. But obviously, Roblox is very interesting because of, as you mentioned, sort of the stats that are out there. They've had tremendous growth. I'm just sort of digging into the numbers when it first came out and looking at the prospectus filing, and they're doing about $1 billion in revenue, but they think that could actually go to $2 billion. And they list adjusted free cash flow at $400 million, which is a fairly significant number. So, if you take a look at the margin there, that's pretty strong. So it'll be really interesting to see kind of where they go and what they're able to do. With your stats that you threw out there about the fact that, most of their audience is under 13. Interestingly enough, I guess a lot of the developers of their game are people who have migrated and, haven't really aged out. They continue to stay on the platform and build games as well. So there's a lot of money and a lot of revenue that's generated by some of these independent game builders. If you're, good at what you do in coding and you can build a game that kids like to play, then obviously you can make money from that as well.
Well, and I think that's part of, so I didn't understand it. I understood it as a free platform, but there's skins that you can purchase and different things throughout the games that you can purchase. And so it was interesting. It allows a game developer to go on, they create a game. And if people go and spend money on that game, there's a revenue sharing model with the developer. And so it's really created this massive community. It was interesting how that all played out, because what they did is they filed with the SEC back in December and announced that they wanted to go public. So the traditional IPO is the initial public offering. You raise capital at the time of going public. They then came and they said, we're going to halt on our application for a moment and work with our advisors. And then they came back in January. They did a $520 million private placement. So they raised capital privately, and then they did this direct listing. So they weren't raising capital at the time of going. So I'm curious who was the shareholders in that $520 million placement, but I think they've done quite well. I don't know the stats today, but I think it's up at least 40% or something insane.
Yeah, it sure is. Yeah.
Okay. So what should we think about going into next week, Bruce?
Well, one of the big things is, from a seasonality standpoint, we know the market's actually almost followed the playbook perfectly here, in that, typically it peaks out, has a strong January, February, and early March, then has a little bit of weakness into the end of March, and then basically starting almost the beginning of April, has a fairly strong trend from, kind of April right through to the beginning of June. So it'll be really interesting to see if after the sell-off that we saw, what we see, kind of as the calendar rolls over to April. And then a lot of that has to obviously do with rebalancing. And then also, kind of what leads the way here. We've seen some sell-offs in a lot of, kind of high-flying areas, and we've seen money rotate into other areas. And we're obviously watching that quite closely. From our perspective, we use our own asset leadership model here at StoneCastle. And what we've seen is that, the energy and financial sectors have seen sort of long-term flows. And then just recently, we've started to see some flows into consumer staples and utilities. And so we'll want to watch that quite carefully to see if that consumer staples and utilities continues to see money flow.
Wonderful. Well, listen, thank you for joining me live, Bruce. I look forward to seeing you again next week, and we'll talk about what happens then.
Sounds good. Thanks a lot. Have a great weekend.
You too. Thanks.